I think earnings season is going to give us a pretty clear view as to the outlook for growth here in the United States and whether that broad weakness in manufacturing is beginning to infect the labor markets.
Peter, let's go to you. What are you expecting out of earnings season?
Well, earnings are expected to be down. I want people to be looking at the pre-stock buyback number to really get a sense of terms of the organic trend. The tariff increase from 25 to 25% from 10 sort of hit mid-May. A lot of companies at the end of Q1 said, yeah, we can handle a 10% tariff rate, but 25% is going to be much more difficult. So it'll be important to quantify that. I mean, global growth is slowing. It's not an opinion, it's a fact. So earnings will help us quantify to what effect that's going to have on earnings. And with the stock market rally, with earnings declining, it's obviously been multiple expansion pushed by the Fed, and that obviously has to be reconciled at some point.
Right. Well, Peter, you and your note, and I read them all the time, what are we, 18 times earnings? You also point to price to sales ratio, although, frankly, I don't know a lot of people who are really particularly focused on that, although that has hit some recent highs as well, hasn't it?
Right. It's another metric to look at outside of the standard PE ratio. One reason why that has been elevated is because margins have been high, and that's another key point of this earnings season is that 10 to 11% profit margin level is beginning to show some receding, and to what extent that continues will be key for Q2, particularly labor costs, as that is the direct driver and most influential driver when it comes to profit margins.
And I think the labor cost point is key because it obviously affects margins with a bit of a lag. So some of the wage growth that we saw over the past 18 months is finally begin to filter in here and impact the numbers. And if that coincides with an environment where we know there isn't a whole lot of inflation, and to Peter's point, economic growth is slowing, maintaining those margins becomes that much more challenging. You're seeing one-off sectors that are benefiting from margin expansion, but if you decompose the overall earnings growth rate based on analyst estimates this quarter, the majority of it's coming from buybacks. And so the question is, where do we go from here?
Where would you argue margin is a good story? What basket?
So actually in the financial sector, you've seen margins expand quite nicely. There's been a lot of focus on expenses and getting the house in order before recession inevitably materializes at some point down the road. So that's one area where we see relative strength in buybacks. We see good corporate decisions being made from an expense standpoint, and they're cheap. So longer term, there could be value there. That said, they've been pretty beaten up by the market.
David, you go to, well, where do we go from here? Okay, if earnings are not as strong as perhaps we would hope for.
Yep.
Nonetheless, we got a Fed that is going to be potentially aggressively cutting rates, or at least cutting rates. So how do equities not still stay favored over obviously lower yielding instruments?
So I think that if you're a broadly diversified investor, that's the issue, is what are you going to buy? The TINA trade is very much back in vogue because you're not getting paid on fixed income. You are getting paid in equities. In some cases, the dividends are higher than the 10-year bond yield. But, to me, this is a brewing pullback in bull's clothing, because at some point the lack of earnings growth will expose itself. The Fed may change course, or the Fed will keep cutting, and that's not a good thing, right? A couple of insurance cuts is fine, but one of the things that I picked up on in Powell's testimony last week was he said, the June jobs report didn't change our view on where things are headed. Are they seeing something different in the market that the rest of us are? And should we perhaps be a bit more concerned than the stock market would lead us to believe?
Peter, this is turning into a pretty widely shared view. That is, if the Fed cuts once, that's one thing. You might be able to escape that cycle and equities can outperform. But if this is the beginning of a sustained cut, history shows that's not good.
Right, because it's usually in the midst of a recession, just as the prior two rate-cutting cycles we saw. I mean, a soft landing is a rare occurrence. Since World War II, the Fed has been on 13 rate-hiking cycles. Only 3 saw that soft landing. So we're going to obviously try to thread that needle and get it this time. But the cost of money is already so low. So by trimming it even more, is that really going to encourage faster economic growth? I'm suspect of it. And this trade war, which I think is sort of intensifying, and I don't see any sign of any deal, as long as this continues, I don't see, at least in the manufacturing side, accelerating anytime soon. And then to the profit margin story, well, profit margins are beginning to get clipped because of higher labor costs. How are companies going to deal with that? Are they going to hire less? Are they going to start to try to raise prices? There's going to be a corporate response to that trimming of corporate profit margins, which I think will be really important and will affect what the Fed does.